The unthinkable thing that is about to happen to stocks is this. The market can keep hitting all-time highs. Your account balance can keep going up. The news can keep telling you everything is fine, and you can still be getting poorer every single day without even noticing it. I know that sounds impossible. I know it sounds like a contradiction. Up is up, right? More dollars in your account is more wealth. That's what we're all taught. But it's not true. And understanding why it's not true is maybe the single most important financial lesson I can give you, because I believe we are getting close to a moment where a lot of people are going to learn this lesson the hard way. And I'd rather you learn it here for free before it costs you anything. So let me explain what I mean, and I want to do it slowly because this isn't complicated once you see it. But almost nobody ever gets shown the picture properly. Think of the economy like a machine, not a mysterious, unknowable thing that only people in suits on television understand. A machine with simple parts that does the same basic things over and over again. Money moves around this machine. Debt gets created, debt gets paid back, or it doesn't. Prices go up and down, and this machine runs in cycles, the same way seasons run in cycles, the same way your own body runs in cycles of being hungry and then full, tired, and then rested. There's a short cycle, which usually lasts somewhere around 5 to 8 years, where credit expands. People borrow and spend. The economy heats up, then it cools down, and it repeats. And most people have lived through a few of these. You probably remember one or two without even realizing that ends what you are watching. But there's also a much bigger cycle underneath that one, a long-term debt cycle. This one takes 50, 70, sometimes 80 years to complete, which is exactly why almost nobody alive has any memory of the last time it happened. It's like a type of storm that only comes once in a lifetime. You don't prepare for it because you've never seen it. Your parents maybe never saw it either. And by the time it arrives, everyone is standing outside without an umbrella asking what's happening. Here's what that long cycle looks like in simple terms. A country starts with very little debt. Borrowing is healthy. It funds real things, factories, homes, roads, businesses. Over decades, more and more borrowing happens because borrowing feels good in the short run. Politicians love it because it lets them spend without raising taxes. Companies love it because it lets them grow faster. Regular people love it because it lets them buy a house or a car today instead of waiting. And for a long time, this works beautifully because debt is really just moving spending power from your future self to your present self. You are, in a sense, borrowing prosperity from your future. But eventually, and this always happens, the bill comes due, the debts pile up faster than the income needed to pay them. And a country, just like a person, reaches a point where it owes more than it can realistically pay back through normal means. At that point, the people in charge of the machine, meaning the central bank and the government, only really have a small handful of choices. They can raise taxes and cut spending, which is painful and unpopular. They can default on the debt, which is terrifying and destroys trust. And this is almost always the one that gets chosen because it's the least painful in the short run and the easiest to hide. They can print new money and use it to make the debt problem feel like it's going away. I want you to sit with that for a second because this is the heart of everything I'm going to tell you today. Printing money doesn't make wealth. It cannot. A government printing press has never once in the history of the world created a single extra pound of wheat, a single extra hour of labor, a single extra ounce of copper. All it can do is create more claims on the same amount of real stuff. And when you create more claims on the same pile of stuff, each individual claim, meaning each dollar, becomes worth a little bit less. That is currency devaluation. It is not a theory. It is basic arithmetic, and it has happened without a single exception to every empire and every currency that has ever taken on debt of this size and reached this stage of the cycle. Not most, every single one. Now, here is where it connects to your stock portfolio. And here is the unthinkable part. When a government starts printing large amounts of money to manage its debt, that new money has to go somewhere. Some of it goes into wages, some into government spending, some into the banking system, but a huge amount of it also flows into financial assets, things like stocks, real estate, and bonds, because that's where money looks for a home when there's more of it floating around than there are good places to put it. So what happens to the stock market during this kind of period? It goes up. Often it goes up a lot. Headlines celebrate it. Your statement looks great. Everyone feels like a genius. But here's the trick, and it's the part that almost nobody explains properly. If the stock market goes up 30% in a year, but the value of the currency those stocks are priced in has been quietly cut by 40% through printing and devaluation, you have not actually gained anything. You have lost. You just can't see the loss because it's not written on your statement. Your statement only ever shows you the number of dollars you had. It never shows you what those dollars can actually buy. That's the trap. That's the unthinkable thing. A market that is climbing in nominal terms while your real, actual purchasing power, the thing that determines whether you can afford your life, your retirement, your kids' education, is silently shrinking underneath you. Let me give you a real historical example, because I don't want this to feel like a scary story with nothing behind it. Go back to Germany in the early 1920s. The stock market there, the actual German stock exchange, went up by what looked like an almost unbelievable amount during that period, something like 100 times over just a couple of years. If you only looked at the stock chart, you would think the German people had just experienced the greatest wealth explosion in human history, but the currency, the mark, was being printed so aggressively to deal with war debts that its value collapsed. People were famously carrying wheelbarrows full of cash just to buy bread. When you adjust that same stock market chart for what the currency was actually worth, the picture completely flips. Investors in German stocks during that period, in real terms, in terms of what they could actually buy with their money, lost the vast majority of their wealth, even while the number on their brokerage statement was going up and to the right the entire time. The chart lied, not because anyone was cheating, but because a rising number in a shrinking currency is not the same thing as rising wealth. I'm not telling you this because I think we're about to see anything that extreme. And I want to be careful here because fear sells. And I don't want to sell you fear. I want to sell you understanding. But I'm telling you this because the mechanics, the actual gears of the machine are the same mechanics playing out right now, just earlier in the process, and at a much less dramatic pace. We have a level of government debt relative to the size of the economy that historically has only ever been resolved in one of a small number of ways. And printing has been, by a wide margin, the most commonly chosen path because it's the one that doesn't require anyone to vote for something painful. Now let me tell you about a mistake I made early on because I think it's more useful than any theory I could give you. Years ago, I was paying close attention to markets during a period where the government made a sudden, dramatic change to how money worked, essentially breaking a promise that had held for decades about how currency was backed. I remember genuinely believing that stocks would fall hard that day because on the surface it looked like terrible, shocking news, the kind of headline that should scare money out of the market. I was so confident I made a real bet on it, and I was completely wrong. The market didn't fall, it jumped, it surged, because the market understood something I hadn't yet understood, which is that when a currency's backing weakens, money doesn't necessarily run away from stocks. Sometimes it runs straight into them because stocks represent ownership of real things, real companies, real factories, real brands, real cash flows, and real things are exactly what people want to hold on to when they sense their money is losing its footing. That mistake cost me real money, but it taught me something that has stuck with me for my entire career, which is that I don't actually know what's going to happen next. Nobody does. And the moment you think you can predict these things with certainty is the moment you become dangerous to your own money. The people who tell you they know exactly what the market will do next are almost always wrong. And the ones who are occasionally right are usually just lucky that time. There's an old saying that fits this perfectly. The people who live and die by predicting the future usually end up getting hurt by it. So instead of trying to predict, I learned to prepare. And that difference, prediction versus preparation, is everything. So let's talk about what preparation actually looks like, because I promised you I wasn't just going to scare you, I was going to give you something useful, a way of thinking you can actually use. The first principle is this: you cannot know exactly when or how this plays out, so don't build a plan that only works if you guess correctly. Build a plan that works across many different possible futures. I sometimes think of it like packing for a trip when you don't know the weather. You don't check one forecast and pack only shorts. You pack for rain, for sun, for cold, because you genuinely don't know which one you'll get. And the cost of being wrong is too high to gamble on a single outcome. Your money deserves the same kind of humility. The second principle is diversification, but real diversification, not the fake kind. A lot of people think they're diversified because they own 10 different stocks. But if all 10 of those stocks are large American technology companies, you don't actually own 10 different things. You own one big bet wearing 10 different costumes. If the thing that hurts one of them hurts all of them, you are not protected at all. Real diversification means owning things that behave differently from each other when the environment changes. Some assets do well when growth is strong and money is cheap. Other assets, like certain hard assets and inflation-protected holdings, tend to do better, specifically in the kind of environment I've been describing today, one where currencies are being devalued to manage debt. Owning a mix of these in a way that's actually thought through and balanced, rather than just spread across a pile of random names you like the sound of, is one of the few things that has reliably protected people through every version of this cycle throughout history. It's not exciting. It won't make you rich overnight, but it's the closest thing to an all-weather approach that exists. And when the unthinkable does eventually happen, in whatever form it takes, it's the people with genuine balance who keep sleeping at night while everyone else is checking their phone every 5 minutes in a panic. The third principle, and I think this one gets ignored more than any other, is to pay attention to what's actually happening in the machine, not what the headlines are telling you to feel about it. Headlines are built to grab your emotions, not to inform your decisions. The debt levels, the amount of money being printed, the direction of interest rates relative to inflation, these are things you can actually track calmly, like checking a weather instrument, without needing to predict anything. When you see debt growing faster than the income that's supposed to pay for it, and you see the money supply expanding rapidly, you don't need to know exactly what day the storm arrives to know that it's smart to have a raincoat ready. I also want to say something about gold and hard assets here, because people hear this and assume I'm telling you to become a doomsday prepper, and that's not it at all. Throughout history, whenever currencies have gone through periods of heavy devaluation, certain hard, tangible assets that can't simply be printed into existence, things like gold, have tended to hold their real value in a way that pure paper currency, and at times even stocks, have struggled to match. That doesn't mean you should dump everything into it. It means a small, sensible allocation to these kinds of assets acts like an insurance policy. You don't buy home insurance because you're certain your house will burn down. You buy it because if it does happen, you want to still have something standing. That's the mindset, not fear insurance. Now, I know some of you are thinking, all right, this all sounds reasonable, but should I just sell everything and hide in cash until this all blows over? And I want to answer that directly, because it's actually one of the most dangerous ideas in all of investing. Cash, in this exact scenario I've been describing, is one of the worst places to hide, because cash is the very thing being devalued. If the whole story here is that the currency itself loses value, sitting in a pile of that same currency doesn't protect you from the problem. It makes you the most exposed person in the room. It feels safe because the number doesn't move, but the number not moving is exactly the trap. Remember the German example. The people who felt safest holding cash were often hurt the worst, because their sense of safety was based on watching a number that wasn't telling them the truth anymore. So the answer isn't to panic, and it isn't to hide either. The answer is balance, real balance, built calmly before you need it, not scrambled together in a rush after the headlines finally catch up to what the machine has already been doing quietly for years. There's one more piece of this pattern I want to walk you through, because it's the part that ties everything together, and it's about something bigger than any one stock market. Throughout history, the country that controls the world's leading currency, the one everyone else trades in and stores their savings in, has changed hands more than once. It happened to the Dutch centuries ago, when their currency and their trading empire dominated the world and then slowly over decades lost that position. It happened to the British after that, when their currency was the one the entire world leaned on, right up until debts piled up, wars were expensive, and that position quietly transferred to another currency. Each time this has happened, it followed a strikingly similar path. Rising debt, heavy money printing to manage that debt, a widening gap between the wealthy and everyone else, which breeds resentment and internal conflict and a slow loss of trust from the rest of the world in that currency as the store of value it once was. None of this happens overnight. It happens slowly, quietly, over years and sometimes decades, which is exactly why it's so easy to miss while you're living through it. You don't wake up one morning to a headline that says the shift has happened. You only really see it clearly looking backward, which is precisely why I think it's worth understanding the pattern now, while there's still time to prepare calmly, rather than trying to figure it out in the middle of the storm when everyone else is scrambling for the same exits at the same time. I think about my own family when I think about this stuff. Honestly, I think about sitting down with people I care about and explaining why I don't want all of our eggs sitting in one basket, even a basket that's been very good to us. I've made plenty of mistakes with money over the years, plenty of them, and almost every single one of those mistakes taught me more than any success ever did. A pain when you actually sit with it and study it instead of running from it turns into some of the best education you'll ever get. I try to treat every mistake like that now, not as something to be ashamed of, but as tuition I already paid for. So I might as well learn the lesson properly instead of paying for it twice. Let me give you one simple way to actually check your own portfolio against everything we've talked about today. Ask yourself 3 honest questions. First, if the currency I'm holding my wealth in lost a meaningful chunk of its value over the next few years, would my overall portfolio still be okay, or would it fall apart along with the currency? Second, am I actually diversified across different types of assets that behave differently from each other? Or do I just own many versions of the same basic bet? And third, am I making any of my decisions purely out of fear or purely out of greed, chasing whatever went up last month, or running from whatever went down? Instead of following a plan I actually thought through calmly ahead of time. If you can answer those 3 questions honestly, and you don't love your answers, that's not a reason to panic. That's useful information. That's the whole machine talking to you, telling you exactly where to focus your attention. I want to be really clear about something before I wrap this up. None of this is a prediction of some sudden crash next month or some specific date you should be terrified of. I'm not in the business of scaring people into decisions. And honestly, anyone who tells you they know the exact timing of something like this is telling you more about their marketing than about the actual economy. What I am telling you is that the gears of this machine have turned this way before many times across many different countries and many different centuries. And the pattern doesn't change, even though the costumes and the headlines around it always do. Debt gets too large, money gets printed to manage it, currencies lose value, stock markets can rise in that same broken currency and create an illusion of wealth that isn't real wealth at all. Understanding that pattern doesn't require a crystal ball. It just requires actually looking at history honestly, instead of assuming this time is somehow permanently different, which is usually the exact thought people have right before it turns out not to be different at all. So here's what I genuinely love for you to do. Take 5 minutes this week, just 5 minutes, and actually look at what you own, not what you feel about it, not what you hope it does, just what it actually is. How much of it is genuinely different from the rest, and how much of it would all move together in the same direction on a bad day If you want a simple worksheet that walks you through exactly how to check your own portfolio against everything I explained today, the three questions, the diversification check, all of it laid out in plain language. I put one together and it's completely free. I'll leave the link right below this video. Just go grab it. It takes about 10 minutes to work through properly. And if this actually helped you see something you hadn't seen before, do me a favor and share it with one person in your life who you know is sitting there feeling good about their portfolio, without ever asking themselves whether the ground underneath it is as solid as it looks. Drop a comment below and tell me one thing from today that you're going to go check in your own accounts this week. I read every single one of them, and I'll be honest with you about what I think. Understanding how this machine actually works is one of the most valuable things you will ever learn. And once you see it clearly, you can never quite unsee it again, which honestly is exactly the point.